I think you know everybody on the panel. Everyone should know Timothy. Tim, how long have you been governor of the ECC?
Almost 8 years.
Almost 8. He doesn't look like he could be governor for 8 years because he's so young looking. 8 years. 2 years. Kevin, 1 year.
7 months.
7 months. So, Tim, you are the old man on this panel. And you know, I've been 4 years in this seat. And it's been 4 very interesting years. It's like being on, you know, that when you put you on a cattle and it kind of gallops and tries to throw you off. That's how I feel the 4 years have been, because we have had some experiences that are just straight out of the ordinary. Now, we're accustomed, I guess, in central banks to have you know, periods when you have to tighten and periods when you loosen. But generally those come along and they pass and they're almost uneventful. You just take them in your stride. We're small, open economies by and large, and so we are very affected by what happens in the world, whether it's, you know, to do with medical issues like SARS, or it's to do with financial issues, whether it has to do with geopolitical matters. We're very affected. Can't avoid it, really. So we are kind of accustomed to take that in our stride, too. But recently, along comes the COVID pandemic. That is not a SARS. It shuts down the whole world totally. And it disrupts all of the supply channels. It is in that period, we find that as central banks, we have to open our arms, loosen our policy, put liquidity in the system, make sure that nothing runs aground, and worst, something run aground that is systemic. But right towards almost the middle or the end of that, the height of that pandemic, comes the war with Russia, between Russia and Ukraine, and the threat of inflation. So immediately the major markets start to tighten. And indeed, many emerging markets sense that they do need to tighten, and tighten before the Fed and before the EU. So right on the back of the pandemic, we have this new crisis of rising interest rates, a geopolitical war, and inflation that is threatening to gobble up everyone. Banks start to see their balance sheets go wonky, where they thought they had great long-term investments, bonds. All of a sudden, they are underwater, and they have to take those unrealized losses to their P&L. And what it teaches us is that more and more what we are finding is that these crises are deeper and more frequent. And it seems to me that central banks need to appreciate that and be vigilant about coming crises, potential crises, be nimble and be prepared to do what is necessary to ameliorate those crises. And that is really the theme of what we want to discuss this morning. And so I want to start with asking a general question. How do central banks anticipate, and how did your central bank react to the crises of the pandemic, followed by the Ukraine-Russian war, and the threat of inflation and the rise in interest rates globally? I'm going to ask each of you on the panel to answer. And if I start with Timothy, he's the eldest of them all, so let's leave him for the last. Right? And start with Kevin, who is a youngster on the panel.
Good morning, everyone. It's good to be the youngster on your panel.
It's a compliment.
I know. Exactly. So I can claim deniability, and I wasn't around and all that. I was there though on the side of government, working with the Prime Minister's team as their advisor. But as we all know, the COVID pandemic, followed by, we had a number of shocks in Barbados, not just the COVID pandemic. We had the ashfall coming over from the volcano eruption. Then we had Hurricane Elsa. We had so many shocks that those shocks are the norm. But starting the pandemic, how the bank responded was really to try to accommodate as much as possible an easy financial system. With a fixed exchange rate limits what we can do. But one, we would have reduced our discount rate, and we moved from 7% to 2%. We have a security requirement that went from 17.5% to 5%. And then there's a security requirement on Part 3 companies that was eliminated. But I think the most important thing that the Central Bank did was to work with the commercial banks in terms of regulatory forbearance to allow banks to be able to give a moratorium to customers between 3 and 6 months, and that regulatory forbearance allow customers to the space needed in order to be able to get their act together and to withstand the shock. In Barbados, COVID, the shock was so severe that COVID eroded our economy to the extent that we had 15% decline in real economic activity in that year, which is massive. And so the bank, in terms of that regulatory forbearance with us, it was very important. We also had a facility where we were in a position to collateralize loans from banks and provide liquidity on it, but no bank needed it. So we didn't actually had to use that. Of course, while on the monetary side, we would have done what we could have done to keep the banks up and running, and they remain quite stable. We also work, as you appreciate, very closely with government, because in these small economies, fiscal and monetary have to work hand in hand. And so we have supported government in a number of activities in terms of analysis, et cetera, allowing the government to be able to respond. We have a program with the IMF, EFF, and that was going on at the time. And so the bank would have provided a lot of analysis in terms of understanding the impact of the shock and telling government how it can possibly mitigate. So, for example, we were supposed to have, at that point in time, a 6% primary balance. And by carefully maneuvering and providing necessary analysis, we will support and show how we can still maintain fiscal sustainability while running a much smaller primary balance slowly. So I think that economic analysis coming from the bank was very, very important. When we get around to the Russian war and Ukraine war, the impact, of course, is through inflationary effects. And we didn't do anything on the interest rates in Barbados because, again, we wanted to maintain a more expansionary position, but also, in our countries, inflation, most of it is imported inflation. So in Barbados, it's about 75%. So there's not much you can do, except on the fiscal side. Now we support government actions in trying to mitigate and analyze what to be done. So on the fiscal now, government would have, for example, slashed some its VAT on electricity, cap its VAT on fuel, enter a social compact with the private sector to cap a basket of goods, 44 items, And as much as possible, we were able to keep the reins on inflation so that at the height of it, we were probably just about 6 or 7% increase in the rate. And that proved to work and contain the inflationary pressures. It was limited because at the same time, the economy was opening up. And so it was demand for goods and services and everybody eating out and everything. So we kind of still in that position where inflation is elevated because of domestic pressures, even though oil prices have started a bit. When you turn around to U.S. tightening and constant increases again, then we haven't done very much except to maintain our stance in trying to provide that support to government and fiscal in what can be done to keep the inflationary pressures. As a fixed exchange rate, we tend, over time, we follow the U.S. inflation rate, and we try to minimize the deviations. And that's what we focus on. I'll stop there.
Thank you, Governor. So it's important to give just some highlights, statistical data on the year 2020. So GDP contracted sharply, almost around 14%. Tourism fell by around 71%. Now, that's because we had first quarter visitors before COVID hit our shores. So COVID really arrived in Belize around mid-March. So we were coming off of a record year in tourism. Now that's the tip of the spear, simply because tourism contributes a lot to our labor market, significantly to our foreign reserves, inflows of US dollars. So we understood immediately what the ramifications were of this attack, if you will. On top of that, there were no fiscal buffers whatsoever. Fiscal deficit, primary deficit was around 6.3%. At the time, by the end of the year, our debt to GDP ratio under the previous measure, and I mean previous measure because we did a rebasing exercise, neared 133%, one of the highest in the region. So these were the challenges we were facing. Now, this is a shock to real income, economic activity. And so early on, the central bank realized that it was important in similar case, similar style to Barbados, to make sure that liquidity was available. So there's what's available in your policy toolkit, and there's also the operational focus. So we lowered reserve requirements, both on a cash and statutory requirement, the other liquid instruments that we can manipulate. So we dropped those by 200 basis points each. That injected around $60 million directly into the commercial bank's balance sheet. This is early on. This is, I believe, the end of March, maybe April. So that was within the context that we know that there would have been a deterioration in asset quality on the balance sheets of these DTIs. And then while we didn't fully map out the forbearance strategy and then the exit strategy that were to have come, we knew that, well, let's give credit where credit is due. The IMF certainly held our hand in developing that strategy. So we engaged with the IMF in probably 3 rounds of consultations to develop this strategy. And that was extremely helpful. So we consulted, relied on, partnered with the DTIs. We made sure that communication lines were open. We pushed forbearance. We changed our prudential requirements for provisioning to allow more flexibility, to give them the space to refinance, restructure some of these, or a lot of these facilities that were on the balance sheet. We also manipulated risk-weighted assets because we wanted to ensure that capital was available also on the balance sheets of commercial banks. But shifting off of the policy side, operations or focus on operations, we also had to re-examine and look at. So business continuity arrangements. Remember, most countries were on lockdown. We're heavily cash-intensive economies, and how do you allow daily economic activity in whatever form that existed then to continue? So how do you get cash to ATM machines? That sort of thing we had to look at. So we encouraged, again, business continuity plan, and key to that was cybersecurity. I'm not sure how many in the region experienced this, but what we saw was a sharp rise during COVID of cyber attacks. So we wanted to ensure that there was vigilance on that end as well. So again, pushing DTIs to step up their business continuity arrangements. The government was also a key partner. I think Kevin said it, and the room is fully aware. We have a traditional peg. There's not much autonomy from the central bank under our construct. So in crisis management, it's important to know when to let go of whatever perceived independence you may have had. So collaborating with the government, given the fiscal dominance, ensuring that they also had some level of financing from the central bank was also important for the programs which we had to execute then. There was, lastly, we understand that we are not as flexible on the exchange rate side. There's very little we can do to target inflation. Price stability is executed through the peg, really, and we hold the peg very sacred. What we had to our benefit was the ability to tighten capital controls. It wasn't very popular at all. But if you're losing inflows, if you're losing reserves, and we're a small open economy with a high propensity to import, you had to make sure that there was enough for essential activities, so fuel, medical, that sort of thing. We wanted to make sure that there wasn't this flight out of the country. So exchange controls, we did tighten up a bit. And I'll close there.
Thank you, Kareem. Tim?
Thank you, Chairman. Greetings, everyone. So we live in a shock-prone world, and the reality is that for us in these small states, the shocks keep coming. And that's an important place to start, because the way we think about it is that while we do not like shocks, we live them, and we have to constantly engage and respond. And so a couple of years before the pandemic, we were on this, I was on this campaign about growth mindset in the bank. Because a person with a growth mindset essentially reframes problems as opportunities. And if one can do that, one finds a bigger capacity to absorb shocks and to not bounce back. I like to say bounce forward. So that we were working on this mindset as an institution. Then comes COVID. And of course, many of the things that my colleagues have said, we experienced, so I won't repeat. But I think in a period of uncertainty, when you're governing, what you want to bring is clarity. So as a leader, you want to bring clarity. You want to simplify as much. These are our next two steps. I can't see tomorrow or the year after, but these are the next two steps. So that was part of the job as leader, to bring with the team clarity to what we were going to do. We very swiftly, for example, agreed with our LFIs on the moratorium within a couple weeks of the pandemic being announced. And so again, that settled everybody. So we gave a dispensation for us to sort of carve out how we would treat with that while monitoring it. And that allowed this LFIs, the licensed financial institutions, to move forward with their businesses, governments, households, and so on, and while we looked at other options. Like Barbados, we reduced the discount rate. For the first time in 17 years, we moved it from 6.5% to 3%, 3.5% for over 12 months, and 2% for under 12 months. For the first time in 17 years. Those rates continue to hold. I was asked by the Monetary Council, which are the finance ministers, those are my bosses, direct bosses, when are we going to move this rate? And I said, when tourism recovers. Tourism has recovered in our countries. We are now back to pre-pandemic output levels in most of our countries, and those that are not there should be there by next year. And we now have a proposal before the Monetary Council for later this month to increase the discount rate, not back to 6.5%, but to make an adjustment there. I will say on the foreign exchange side, in terms of the peg, so again, like Barbados, Belize, we track U.S. inflation a lot, so we peaked around 7% with inflation. That's now down to around 3.5%. At the start of the pandemic, or backing, and in law, we have to have the currency backed by at least 60% in foreign reserves. Just before, well, at the start of the pandemic, the backing was just around 101%. That came down during the period of the pandemic, those 2 years when tourism, our largest earner of foreign exchange, was shut, essentially. That came down to around 89%, and right now that has gone back up. It's now around 94.5%. And I make this point to say, we see our strong foreign reserves as a veritable insurance policy. There are those who have challenged us for years about why do you have to carry such high reserves? There's a cost to carrying reserves, and that is true. But the way we look at it is that it's an insurance policy for shocks. And we proved that during the pandemic. There was never any issue about the variability of our currency. There was never any issue about monetary stability. We were able to ride that storm and to go back. And I will tell you, part of the reason why it came down is because of what we were seeing in the markets with some of the losses that we had to take during the period with the Fed, the aggressive rate hikes. That had an impact on us because we do fair market treatment, mark-to-market accounting, and that had an effect on us. The good news is that this is a bounce back year for us, and the numbers are looking quite good. So in sum, I would say we have weathered the storm reasonably well. I should say on debt to GDP ratio, because that's an important metric for us. Before the pandemic, we were at around 65% as a currency union. So I say as a currency union because there are 8 countries. So this is an average. You have some above, you have some below. That's the average. When the pandemic hit, with that growth shock, which was around 16% like Barbados, it shot up to 88%. It has now come down and it's around 72%, and it might by the end of this year get to around 70%. So we have begun to sort of get back on track with respect to the trajectory for the debt to GDP ratio in the ECCU. Our target is to get to 60 and of course get under that. So in sum, we have bounced back. Tourism has been the driver of that recovery. And frankly, had we been better off in terms of connectivity, we would have been even stronger. This year, we will grow by about 6.5%. Next year, around 5%. So we're not doing the lofty 40% as Guyana, Governor Ganga, but 6.5% is not anything to think about. The truth is that we kind of want to see a 5% annually. So that's sort of what we target. Obviously, we can't deliver that all the time, but that is what we kind of look for. Because for us, it is about not just bringing down the debt to GDP ratio, but to answer a question which I posed at the beginning of the year when we started our 40th anniversary celebrations. What will it take to double the size of these economies? What will it take to double the size of these economies? For us, it's a $21 billion economy. How do we get that to $42 billion? And that's a question that we've been exercising our minds on all year. And I'll leave it there.
Thank you, Timothy. The good news is that Gobin has advised me, he just WhatsApped me, that he's going to give us each some growth, some of the oil,
Wonderful.
so that you will achieve
Thank you.
your target. But interesting, you know, because in each case, whether it is Belize, it is Barbados, or it is the ECCB, fixed exchange rates, and their approach to managing is similar in some ways and dissimilar in others. So I just wanted a quick review. Timothy said that his reserves went from 101 to 89.
Yes, the backing.
And your debt to GDP went from about 65 to 86. What is it in the case of Belize and Barbados? That experience, what does that?
So similar to Tim's statutory requirement, our limit is 40% of currency or deposit liabilities on the balance sheet. So we've kept that between 60 and 70%. It didn't fall below that. And using the IMF's international benchmark, we are holding steady at 4 months of import coverage. So that's good. On the 133%, which was the old base, the old GDP base, if you look at where we position or landed after the blue bond, after further fiscal consolidation efforts, we are around 64% now. So it was a sharp turnaround, aided by those things, and then the rebasing exercise, which added another 27% to our denominator, the GDP. So looks pretty good in terms of now fiscal buffer and macroeconomic fundamentals.
Kevin?
Yes, in terms of the debt, prior to the pandemic start in March, could start the last 2 weeks of the fiscal year, March 2020, our debt had fallen from 178% of GDP at the beginning in March 2018 to 117% by the start of the pandemic. But of course, during the pandemic, with the base contracting, much of it was through the growth, the base. Our debt went up to 143%. And we had to be constantly explaining, well, I did a lot of that. I wasn't governor at that time, but on the other side, on the government side, explain to the person that there's no reason to panic. Just as the base contract, it will expand again. So it's not because you take on new debt, but because you have a shock. And so now our debt has come back down to 115% at the end of, but the last number, in August, 115%. We also, like the rest, we're targeting a trajectory that takes us to 60% by 2035, 36. And we have our macro framework incorporating the government position in terms of primary balances. We're well on our way to doing that. And so
Reserves?
I think,
Your reserves?
reserves was about $3 billion at the start around that time, and we hadn't had an impact on our reserves at all. I mean, no one was importing anything, even though on the one hand, the tourism went from 70,000 visitors a month to 100 persons landing, 100 literally. So we had nothing there, but on the import side, nothing was happening. So we didn't get a shot to reserves. And Anthony put Anthony spot. What's the cover? He's supposed to know these things. That's his job.
Well, right now we are just about 29 weeks.
No, I mean the ratio, in terms of backing for currency. He doesn't know.
Don't know.
But it has to change. We have 29, 30 weeks now because the economy recovering. But during that time, we had like 32, 33 weeks of import cover. And that was a level of confidence. It was never an issue. Never an issue about the reserve cover. Never an issue about the exchange rate. All the discussions circle around debt, when the economy recover, et cetera. So we had to be telling persons it will recover once you get growth.
Yeah. So interesting, different ways to arrive at the same solution. In our case, we raised interest rates dramatically from 0.5 to 7. We have kept it there from November of last year. And our reserves are larger today than they were at the beginning of the pandemic. Growth is bigger than it was at the beginning of the pandemic. And our debt is lower than at the beginning of the pandemic, which is more or less the case that I'm hearing in all instances. So, as I said, just different methods to arrive at the same solution. Interesting. So, Kareem, can I ask, what would you say are the critical lessons that you have learned in this period of the shock? And, how do you see yourself applying those lessons in the future?
So there are a few of them, and in no particular order. I think you have to look to the past. There's always lessons to be learned. There was the great moderation, if you will, and then the global financial crisis. And that had a significant impact on Belize also because income in America was slashed and the same transmission through tourism. And we saw what happened on the balance sheets then of DTIs. So we had an idea of how to address this situation already. So that's one, look to the past. The second one is never waste a crisis. From our relationship with the government, we saw it as an ideal opportunity to get certain amendments to the Central Banking Act. They had more the appetite than to listen to you. And just before I go into what one of those amendments was, it's set the stage now to look at a whole revamping of a new Central Bank Act. We haven't really done that exercise in over 40 years. And in this polycrisis environment with the central bank's mandate widening, if you will, this is an ideal time to re-examine what currently this dated Central Bank Act is. So that's one. But in that time of crisis, what we pushed the government to do was to look at the capitalization of the central bank. So we wanted also to make sure that should one of these systemic DTIs fail, that there was a big enough bazooka, if you will, that the central bank could have supported that financial institution. And there's various arguments on how central bank's capital is important. We could have another topic on that, but we wanted to make sure, a discussion on that, we wanted to make sure that we slid in one of those amendments and it worked. So the government in our case took 90% of our income every year and the central bank retains 10. So we changed that sharing arrangement to 70-30. And that helped quite a bit. And the government also placed an additional 20 million in the central bank. So again, never waste a crisis. And we sort of courted the government to look at the central bank or to understand why these amendments were necessary. On top of that, we realized we needed to do more on mobile payments, fast payments network, layering on top of our APSS system. The commercial banks tend to not cooperate in our jurisdiction, maybe in others. So the central bank took that investment. So we developed the RTGS. We also did the app system. And now there's a need for us to even accelerate the way in which we focus on mobile payments and modernization, that sort of thing. And we are currently investing quite a bit with the assistance of the World Bank in doing that. And I think this is the most important part. Pay attention to your staff. That's critical. Now, before COVID, we had 2 international bank failures in succession, a combined balance sheet of around $300 million, so not small. The supervision department, and I have the manager and assistant manager in the back, and their staff really put in a lot of hours to really look at the resolution framework and coming out of and addressing those 2 situations. So there was quite a lot of heavy lifting and long hours put in by the supervision team. And then when COVID came, research side did a lot of work, operations did a lot of work. So there was evidence, clear evidence of burnout. So you have to watch that very carefully and check the morale of staff. And I think that's one of the more important things which you can't ignore. We can't always be focused on the work that's out there, but you got to look to your staff to be very mindful of their importance. So keep that in mind. Invest again in your staff. Try to find activities that could lessen some of this burden and stress. And I think that will pay off serious dividends in the end. That's it.
Thank you, Kareem. I would add to that building resilience is really important, resilience in the DTI sector. And so, all of the plans that we have going forward, Basel III, all of that stuff is so important because the shocks are just going to get stronger and more dramatic. And to act early, I think that is another lesson that I would say. When you read the signs, don't be afraid to act. A lot of the emerging markets did act early, and I think that helped a lot in getting us ready to face that tidal wave when the Fed and others moved. Tim, what would you say are the main lessons that you would learn from this?
Expect the unexpected. I mean, I agree with all that Kareem said. I mean, you have to, as I said, you have to provide clarity even in a period of uncertainty. Certainly where you see red flags, try to act early. But there are instances where you have to respond. And at that point in time, it can't be feeling sorry for oneself. It is really about now, how do we go forward and bring everybody along. I think listening to the team is very important. Listening to your own heart is also important. And trying to make sure we sort of bring all the inputs together for good decisions. But certainly, I really want to stress the issue of solidarity and collective action. And of course, coming from a currency union of 8 countries, but also even across the Caribbean community as central bankers, I cherish and greatly value the solidarity amongst us as central bank governors. If we call on one another, I call on a colleague, the colleague will help, whatever they have. And I like to think we also replicate or we repay that in terms of anything we have, we make available. That solidarity for us is a beautiful thing. I saw it, for example, in the pandemic with vaccines. In our region, we were struggling to get vaccines, as you know. The big countries had taken all the stock and were holding them. And we got some initially from India, a particular member country, and rather than take all for that country, the country offered to share what they had while we waited on getting some additional supplies. The same is true for credit. So part of our secret sauce, if you will, at the currency union is that we do not print money. Hello? We do not print money. What we do is we manage a credit allocation for 8 governments, and we stick within the lines. But if a particular member country exceeds their credit allocation, that country can call on another member to use part of their allocation. So we're still within the overall envelope, but we share. We've done that in crisis times. We've done that in times, even a pandemic in 1 or 2 countries. That solidarity, as I said, is a beautiful thing. And I want to say, for me, solidarity and collective action in crisis or in challenging times is a very powerful, not just lesson, but antidote for how we have to navigate those difficult things. And I believe that is something we should continue to build. That capital is something we should continue to build because it serves us well, especially in difficult times. So I would say those would be, and then to the point of seizing the never wasting a crisis. Look at what digitalization has done. We really made rapid strides with digitalization. We made rapid strides with working from home, which is part of business continuity. We know we now have the capacity to work from home and perform at a high level. I'm not speaking for every central bank now, I'm speaking for this particular central bank. I know there are mixed views on these matters, and I respect my colleagues who may have different views. We know that, and I say that that is important because we have to know in the event that we have another pandemic or we have some kind of activity, we could shift to remote working full-time and perform at a high level. At the moment, we have a hybrid, 3 days in, 2 days out. You're free to come in every day. Some of us do, including myself, but that's the model we work with. But in an 8-country currency union, we have to avoid shutting down St. Kitts, where we're based, because that affects the other countries where we're not based. And therefore, we always have to be thinking about not just where we are, but the 8 countries that we serve. So I think one of the lessons was we were able to really move along on digitalization, the benefits from that, and of course, there are risks that we have to manage where that is concerned. And that was, again, one of the opportunities that we seized. And I think we're better off for having done that. So I'll leave it there.
Thank you, Timothy. Kevin, I know that Barbados is very much involved in climate change, and you have this big tourism business, so it's a good reason, amongst other reasons, to be very involved. So how do you incorporate environmental considerations in your work at the central bank, especially when you're supervising the DTIs?
So, well, this is perhaps one of the areas in which we still have a long way to go, admittedly. Following the crisis, we've started to intensify work in that area in a number of ways. One, building our staff capacity, particularly research and economics department, so we can monitor and assess climate-related financial risks. And me, as governor, this is something I want to push on to continue to focus on training, capacity building. Yes, aspect of that that we started to do is also to look at our regulatory framework. I mean, we're pretty good at assessing the physical risk with respect to climate change, but the financial risk is where we tend to be lagging behind. And so we are now preparing a regulatory framework that will assess and manage that transition in terms of managing financial risk as we expect our work as supervisory work. That regulatory framework we expect will follow the principles on the Basel Committee on banking supervision, the revised core principles. So that's being put in place. I intend as governor also to continue to leverage the experiences of our regional groups, Caribbean group of banking supervisors, for example, CARTAC, CERT, in terms of having integrated assessment models. The third thing we are doing is facilitating research and outreach to the financial sector itself in terms of helping them to address and develop guidelines to assess risk with respect to the institutions themselves. We are looking at data, helping them to improve with respect to the data gathering exercise, to assist with the financial stress testing, technical assistance to provide them with appropriate supervisory guidelines in terms of how they manage that. But I must admit, we are behind the curve on this. The crisis have taught us that we need to accelerate how we do this. We need to be able to assess the exposure of individual license banks and or license to their sectors. We know tourism is very important, and we know it feels true, but we need to individually, as each institution, the individual exposure. We did have regulatory forbearance during it, but it was because of a matter of, so this we have to do. So you need now to proactively develop a framework that will necessitate that. How do we go through if we are, so if the banks know immediately and institutions, this is the framework we operate with respect to our regulatory framework. And where necessary also, improve what we report in guidelines with respect to assessing the risk in that area. But like I say, I'll be the first, admittedly, we are behind the curve with respect to assessing that. Even in terms of, you have our IMF program, we have our second program, EFF now, and we've started to incorporate much of the climate-related stress testing requirements into our program to help us meet certain targets along the way there. So we continue to push on this front and building. So building capacity, building training, revising our guidelines, that's where we're heading, and leveraging the regional experiences.
I think this is an issue that we can all cooperate on because it impacts all of us. All of us have a big tourism component. All of us have the same environmental exposure. So it's an area that I look forward to us collaborating on a lot. So, Timothy, let me ask you, what do you see as the main risk to financial stability post-COVID? Are there any special risks in that respect that you have your eye on?
So we have our eye on credit risk. The truth of the matter is that we had a pre-existing condition of high NPLs in the currency union of around 11%, which is higher than the regional average. I look with, I wouldn't say envy, but admiration when I see your NPLs in Jamaica.
Gina, you can take a ball.
Yeah, and in other parts of the region. We have going back to the global financial crisis, it was 10, 12 years now, we have high NPLs. I think, I call it high blood pressure that we have to manage. I don't like that idea because, they say pressure busts pipes, so you have to be careful with that. But to use a Caribbean expression, but we're managing it. We were actually a little concerned that there would have been a jump during the pandemic. We have not seen that, so that's a good news. So we are somewhere around 11% now and trying to get that down. Excuse me. One of the mitigants we hope in time will be the introduction of a credit bureau. So we're behind on that. We are just introducing a credit bureau in the currency union. We are now, LFIs are signing subscription agreements, and we expect to have the credit bureau up and running fully in the next year or two, as everybody comes on board. So in time that will help, hopefully on the credit risk management side, but that is something we're concerned about, and obviously the implications for capital. We have introduced a treatment of impaired asset standard. We did it a year ago. It got a little pushback, but we said we have to do it now, again, for the reasons you have to do what you have to do. And so we, the provisioning is in good shape. The capital remains very solid across the institutions, even though we saw a reduction with the implementation of that standard. But we continue to monitor that very closely. So there's credit risk, there's climate risk. Kevin spoke about it, and there's not much I would add there. We started our journey about 2 years ago in terms of capacity building, not just in our central bank, but with non-bank financial regulators. So we've shared liberally our experience. Started with Toronto Centre. We've also had relationships with AFD, Agence Française de Développement, and a couple others that work with us on this issue. So we've been building capacity. We're working on issuing a standard with respect to climate, again, trying to address this question of this risk. Geopolitical risk. Look at what is going on in the Middle East. Look at what is going on in the Middle East. We know it's a dangerous thing to try to predict the price of oil, but the reality is that as oil importers, so I'm watching with admiration of Guyana and Trinidad, as oil importers, we are very susceptible to that. And we see it first in the fiscal, and then potentially a channel could be coming back through credit allocation to governments. Because if our governments have to make that fiscal adjustment to cushion the effect, meaning they take less taxes at the pump in terms of the carbon tax, then it means that typically we possibly may see more demands on the credit allocation at the central bank. So we monitor that in addition to the inflation side to see. So far, so good. The other area of risk, so I mentioned credit, I mentioned climate briefly, I mentioned geopolitical, generally speaking, is the whole question of cybersecurity. Digitalization is a powerful thing, a valuable thing, and I don't think we want to turn back the clock in any way on that. But we do understand, with the digitalization, there's a necessity for safeguards. If you ask any governor what keeps them up at night, you might hear cybersecurity in the top 3. Certainly for me, that would be in my top 3. Although I sleep well at night, I will tell you that. But that's another story.
With your high blood pressure.
I don't have high blood pressure, actually, personally. But yes, the financial system does with these high NPLs. And that's an aside. I tell my colleagues, I forgive freely and frequently. That's why I don't have high blood pressure. So that may be a lesson for our young people around the table. But seriously, cybersecurity is a real thing. We have to invest heavily in it. We are. And the more we invest and the more we spend, it seems as there's more to be done. So that's a major issue. We have issued a technology standard at the LFIs, and I will tell you they were very keen for us to issue that standard. Sometimes they're saying, hold on, not too many coming down the pipe at once. They were actually very happy to receive that technology standard from us because we have to work together. And I will say this, in this business of cybersecurity, we have to share with each other. We set up in this central bank, the governance group, a few years ago, the information security group. And we signed MOUs to ensure we could share information. That is important because what we found is that people were suffering in silence. An attack would come or an attempt of an attack and nobody would hear about it. To fight this thing, we have to share information promptly, confidentially, yes, but promptly to protect the system. That is not just our countries, but our region. And so sharing information on what is out there is important so we could avoid. So we ask our LFIs to have the same protocol. We have to manage it in a certain way because there are reputational risks, we understand that, but prompt reporting to the regulators, sharing with the LFIs in a way that allows, expect this or this is what is happening so you can be on the lookout and hopefully preempt those attacks. I understand in the United States every day there are 15,000 hack attempts on the US government. I don't know what the number is in the Caribbean, but rest assured there are attempts or persons looking to damage us and to destabilize our systems. So that is a major, major risk because if you think about what it could mean for financial stability, we cannot take it lightly. So, Richard, I'll leave it there.
Well, Tim, I think that you touched on a point that is really important. We recently, as many people here would know, had a cyber attack on our Financial Services Commission and shut them down, you know. We are just barely building it back now. So we are very sensitive to this issue of cyber attacks. And I think that, again, as you say, can I just commit absolutely to what you said about cooperating and sharing. I know that Alvin is leading, is that correct? The same MOU attempt to share, and we are 100% committed to it. I want to participate in every single way, both in terms of what's happening, what's our experience, but also what we're doing to let you know and for you to tell us what you're doing to harden and protect against these attacks. I would say, too, you know, one of the things that concerns me based on our experience is systemically important financial institutions, the SIFIs. Those are really something to keep our eye on. In Jamaica, we have a couple of them, and whether they're DTIs or non-DTIs, they're big and they're systemic, and they really can expose us to tremendous danger. And that's something I think, out of our recent experience, we want to pay a lot of attention to. I don't know whether Kareem or Kevin want to contribute on this issue of, you know, what is from a systemic point of view of stability, if you see any risk there.
Just align myself to what Tim said, ensuring liquidity capital buffers are there. And we're doing that through implementation, IFRS 9, Basel II, Basel III, and hopefully we get a risk-based supervision back on through Toronto Center. So that's what we're looking at. And we just completed our first round of ICAP assessments. So that those things are very important. Now, we only have 4 commercial banks in Belize. Scotia walked away. One of the domestic banks bought Scotia Bank. So it's a very consolidated system. And if you look at interconnectedness from a financial stability point, it gives me high blood pressure, Tim. And there was smoke before, now we're seeing fires. So Governor Biles, I'm extremely worried about 2 SIFIs, and the vigilance has to be there for us to keep watch on them. But if I could walk away from looking at it from a financial stability point of view, what's also happening in this consolidated system is now oligopolistic type of behavior on fees and charges. So one, they follow the other. You're charging at every point of access to hold the public's money, from ATM charges to ridiculous online fees and charges. That sort of thing is what is really irritating the public, and of course now is being passed on to the central bank to address. We all know that if you start to dictate fees and charges, that could be a slippery slope, because it will be passed on in such a system through some other service or product. But the central bank recently took action on it, and it's a higher level of moral suasion. It's a directive coming from the central bank, and it seems to be working so far. But this is another thing which we have to keep an eye on.
Thank you, Kareem. So I want to ask each person on the panel in turn, what do you see as the main challenges facing the central bank going forward on all fronts? You've been through the storm, but what do you see coming? What are the plans you are preparing for the future? I know that from a stability point of view, building capital buffers are important. So along those lines, what are the ways in which you are preparing for the risks that you see coming forward? Kevin?
Thank you. I think Timothy, and we mentioned here, get mentioned more than once. For me, one of the greatest risks is this increased cyber attacks and how we can prepare ourselves. In Barbados, we've seen an increased incidence of cyber attacks. In fact, we had an incident where a domestic credit union was crippled for quite a while because of a cyber attack. So I think that one of the greatest risks I see. We've started to do a number of things, especially on our side, at the bank side, working with our IT department to put another initiative in place that we can proactively mitigate such risks, and when they do happen, be able to respond quickly. So conducting firewall assessments, we design the rules where there are gaps in terms of that. Things like implementing various firewall surfaces, defining the documenting of cyber instances, but in general, building our cyber resilient capacity. We have mandated cybersecurity training for all staff, so we create this human defense shield against it. And each staff member must complete online tutorials and videos, and because a lot of this time, much of the time, cyber attacks happen because someone is not paying attention, or and so everyone has to do it. Even myself have to go through this kind of training. So I think that's one of the major risks and major challenge, how we do that. Another one will be digital disruption and transformation that we're going through because of COVID and the new world we live in. We had to work from home. We had to be able to work online. We have, because of COVID, moved like our foreign exchange services, applications. We have a foreign exchange approval process, monitoring. All that is online now, and that's because of, it was spurred because of COVID. As Timothy said, I have a very, I changed, when I came in, there was a discussion about returning back to work when I became governor. And what I've done, I have a system in place where a person can work 2 days at home and come to work 3 days. Unlike Timothy, though, I specify which days they come. Because to get, so Tuesdays, Wednesdays, and Thursdays, you must be in the office. Mondays and Fridays, you can work from home. And we got to relook at, but it's been working pretty good so far. But that requires you now to have a whole process that works. So, for example, we have a digital transformation unit set up in the governor's office that leads the path in terms of what we are doing. So things like digital tools, so that since becoming governor, I've only signed one thing with a wet signature, and that was reluctantly to put my name on the currencies. Right? They say they need a wet signature. Beyond that, I have not signed in my 7 months a single piece of paper. Right? Everything is done through the online system, DocuSign, signed there officially. And I've told my staff, I don't sign nothing unless it's legally required of me. And if it's legally required, we're going to look to change the laws. And so, no, because we have to be in an environment that, I mean, I sit there just now and I sign something. So this transformation where we digitize our processes, I think this is the challenge, moving almost everything online. We have, in my office, there's no paper, only a tissue. I told them when to find an app that can do what the tissue does, well, it would not be there. And I've charged the entire bank to become digitized and paperless environment so that we can, and this is part of preparing to work remote online. And I've calculated the savings in 1 year from doing that. It's quite large, a couple of thousands. And I've said, I know the savings, and the first department to go totally digitized and paperless, that's their savings to do whatever they want. Whether they want to take a trip or boat cruise, the entire savings, because I don't mind, because the next year after, I still have those savings, right? It's like 70,000 or something like that for the first department. So I think that's the drive to, and that means now they have to find ways to put all their processes digitized, etc. That's it. Those are the two I mentioned. There are a number of others, but I think those are the main things pushing us. The business continuity environment, managing the remote site and the hot site, and then the bank, and making sure that we can up and running in the thing of a challenge, and if businesses should be disrupted. And of course, then the biggest challenge you mentioned, not only cybersecurity I mentioned, and cyber attacks, but dealing with the climate change and that assessment in terms of our frameworks, how do we move forward. So it's a new game, and my focus then is to enhance what we do good, which is the monetary aspects, the financial stability thing, and get better at what we need to do to prepare ourselves for the future.
Okay. So, Kareem, same question to you, but in particular, the issue of competition. Is that something that going forward you want to try to ameliorate somewhat? Because you really have a duopoly, almost.
Exactly. The staff, they've heard me preach about this quite a bit. My bosses want us to do more of the draconian type of measures. And it's important that I am able to explain to them why these things shouldn't be applied. So yes, my approach has always been to find a way to create more competition. And what I believe is the best route is to bring up the other deposit-taking institutions. The credit union sector, for example, is extremely large. Well, it's of good size. And if we can bring into law a new Credit Union Act and start engineering the changes that we want to see from that sector, I think we have then injected competition to the banks, which will certainly help. So that's how we want to address it. We have received a first draft of our new Credit Union Act, and hopefully I'm able to go to my bosses and say, this is the route. Let's back off from some of the more draconian measures for a little bit. The other concerns, if I may, Governor, is what you mentioned, being more agile, stop being reactionary and more proactive in our mandate. And again, looking at our Central Bank Act or revisiting it will help us along those lines.
Tim?
So just to be clear, we have 3 days in, 2 days out, but we have 2 full force days, Governor Greenwich, Tuesdays and Wednesdays.
Okay.
So everybody has to be in, and typically we do our staff town hall, which we do monthly on the Wednesday, because everybody is in, so there's no reason. So that's the best time. I agree with much of what has been said by my 2 colleagues. I think certainly on the issue of business continuity, we will continue to give a lot of emphasis to that, just to make sure that we are ready. We know we have strong capacity, but we have to get better. I will also say that with respect to the matter of the public, so Karim's comment about the fees and charges, we are in the process now of setting up an Office of Financial Conduct in the Central Bank to address the issue of financial market conduct. We have heard too many stories, and we have to do something about it. We've been looking at what Richard Dornbush, the president of the Central Bank of Curacao and St. Martin, what they have in terms of a basic bank account by law, to see what we could provide. The problem here is that it's too hard to open a bank account in our countries because of AML-CFT rules. And it's gone to an extreme now where it's ridiculous. It's easier to do that in the US than it is in the currency union. That doesn't make any sense. And the truth about it is that part of the reason why we're here is because we're no longer managing risk. Many of us are managing fear rather than risk. So we have to get back to managing risk, using the law, because we have to obviously make sure that we have strong AML-CFT protocols. Financial integrity is important, will always be important for us, but not where we are excluding people, because financial inclusion is also part of our mandate. I will also say that we are working on integrating supervision across the financial sector. We do banks, but we're concerned about the non-banks, and in particular insurance. And that's an area where we are strengthening now. And again, I won't go into the details, but we're working on a regional standard setting body, so we have some coverage, so we minimize arbitrage across the sectors within the financial system. Finally is the issue of talent. We have lost some staff to certain places which shall remain nameless. And we got to have talent to take on the mandate and to do the things that we have committed ourselves to do. We have to have the right people. So it's training, but also recruiting well and retaining the talent. So we have, in fact, just completed, we are a compensation review. We are in the process of working through that. It's always a sensitive issue when you're talking about increasing compensation, but at the same time, we're very clear, if we have to deliver for our countries, we have to have the talent at our disposal. So that is an issue for us that we're grappling with. We have found during this period where you can work from anywhere in the world, talent is a lot more mobile, and therefore you have to respond to that. Some people, the millionaires, want to travel all over the world and work all over the world. And we have found situations where we've had to be flexible with recruitment, without calling specific sectors, no, to allow us to be able to get the talent that we need. Finally, a lot is being placed on the central banks, including our central bank. And we have to minimize mission creep, but at the same time make sure we are we are meeting the moment. We're fit for purpose. I like to say we have to be selective to be effective. Our central bank cannot do everything, but we also recognize that in law, we have to do certain things that a typical central bank will not do or does not do. There are growth and development objectives in the law that we have to support. So finding that right balance is key, and we have to be very thoughtful about what it is that we will do and what it is we won't do, how we will partner, with whom we will partner, to deliver on these mandates without compromising our ability to take care of our core mandates, which of course are monetary and financial stability, and at the same time advancing the growth and development of our region. So it's an exciting time, a challenging time, but we look forward again. And the partnerships around this table and around the world would be key. Thank you.
If we could
Yes, Kevin, sure.
just add, I want to mention two other challenges which my colleagues mentioned. It's the same in Barbados. One is the fees, and that's with liquidity. On the fee side, when I came in, I started work very, well, not draconian, but very close with the banks. Some good hugging we go into. And so I mandated that, in my view, the banks generally in the region, and Barbados, I found that they were in a position where they were doing less financial intermediation and more collection of fees. To the extent that fees sometimes about over 35% of revenues from fees. So that has to stop. And so I've mandated, for example, each bank to give me, offer the customers one fee-free account. And they had to give me that by the 1st of May. Reluctantly, they tried, but it happened. So every bank now has an account where you're not charged any fees at all. Of course, they don't promote it a lot, but and then I push them to do a bit more and digitize. So we have our first digital bank in the region, which is Sagicor, but competition. The other one was on open accounts. Right. It should take 2 weeks, and not all banks. And I secretly sent some people to test the system. You're supposed to be open an account within 30 minutes. Right? So I have my secret people go in and try to open an account. And then they call the bank and we have a conversation. And so it's being, although I don't want to do micromanagement, but I have to go in there. I have to be in there and say why. So for example, I, as governor, got charged a fee that I know should not happen. So I had to call the bank and talk about these things. So dealing with the fees are one thing. I think we continue to push on that. On the other hand, we have a lot of excess liquidity in our banking system. We have like 4 billion in excess liquidity beyond what is required. I don't know what this keep running. And then the trade now, how do we get that into providing into investable projects, into what? And that's been a challenge because have a fixed exchange rate and the way we operate have a very limited ability. I can't mop up all of that. We're starting to offer some reports, etc., but my balance sheet doesn't have the space to be able to conduct this. So now we're in the process of revamping our monetary toolkits and thinking about a liquidity facility window and maybe introducing a sort of a benchmark, almost like a policy rate, to work in tandem. So on one hand, I take some through the reports, I set the policy rate, but I must have a facility window to deal with this. So the whole revamping, I think the same challenges in most of our country. I know in the CCB region you have a lot of liquidity. And I think we need to work together as central bankers. I understand if we look at it last time here, 50 million in liquidity in the entire Caribbean region. And maybe there's a way for us now to start to work together to tap into this, to finance our growth and development through maybe regional bonds, regional green bonds, and regional cleverly designed instruments that are tied to, for example, specific projects, and the returns are tied to the performance of those projects. And try to use that. And if we can get the backing of some international instruments, ADB or Africa Exim Bank recently set up an office in Barbados with 1.5 billion, going to 3 billion, depending. And those sort of guarantees perhaps can help us, but we need to think with all this liquidity in our banking system, instead of us having to go far abroad afield and borrow. expensive rate, we can encourage our citizens to become part of the development process, part and parcel of it. In Barbados, we issue what we call boss bonds, savings bonds, but they have a particular feature, and persons have been taking them up because they want a part of the development. We have marketers helping us to develop our country, so you play your part. 5 years maturity, 4.5% interest. And so maybe a regional approach to this, I think we need to work on that, to deal with the liquidity issue and deal with the fees issue.
Thank you. One of the things that strikes me that's common amongst us all is the reduction in competition in the financial sector. Kareem has spoke about that recent withdrawal of one of your major banks. We're all suffering from it, and it's been going on for a while. And I think we have to look at how to re-stimulate some competition. Our strategy in Jamaica, I would say in the last 15 years, has been to license more domestic institutions to join into the DTI sector. And whilst I would say with very modest success we've had in the last 15 years, because what we find is two institutions that dominate the deposit base. And once you dominate the deposit base, then you have a much larger margin to lend, and you can dominate on the credit side also. And part of the problem is that the new institutions are trying to be Me Too brick and mortar banks and not digital banks. And that is something that we want to look at in the future. How can we encourage more and more institutions to go fully digital? I know that in Barbados you have an example. May not be very successful as yet, but it's one to look at. But also in Latin America, there are several very successful stories. And I think we as Caribbean central bankers should kind of broaden our vision and look at what are these models that can bring more low-cost operations, virtual, digital kind of banking experiences to the marketplace. Because I think that's the only way to start to break into the duopoly. Remember, what we have on our side is the youth coming up. They all gravitate to this digital form of transacting. Even if they're in the same room with one another, it's digitally they want to communicate. So we have that on our side if we start to look at setting up digital banks in the Caribbean. So I want to open up the discussion to everybody here, and feel free to ask questions. Wade?
Thanks, Governor. Good morning, everyone. One quick question. You emphasized, both Governor Antoine and Governor Greenidge emphasized the problem of excess liquidity in your banking system. So I was just wondering, isn't that putting some pressure on the peg, particularly in Barbados' case? Because presumably, yes, you have capital controls in place, but presumably with that excess liquidity, your money supply is probably growing faster than desired. So it's either you're losing reserves, which you're not, or you're running very, very tight fiscal policy. So I was just wondering that nexus between that excess liquidity in your banking system and pressures on the peg.
We don't have any pressures on the peg at all. I keep it very simple. So we have over $3 billion in reserve, 30 weeks in port cover. So there's absolutely no pressure. We have also allowed all citizens to be able to hold foreign currency deposits, and they have to access those before they come to the central bank. From the fiscal side, world government is not very expansive in its thing. It do have a very tight fiscal path in order to maintain that. So there is absolutely no pressure. This liquidity system didn't just appear. This has been over time. Over time, we've been pretty passive in our approach in terms of central bank, Barbados, in terms of trying to mop up that liquidity. And so it's almost become part of the system, so much so. And then following that restructuring, where banks and financial institutions were a bit reluctant after that to purchase any government paper. They prefer to hold the cash. Now we started to say, well, look, the Barbados is back. The economy have grown 10 consecutive quarters. We are larger than we were back in pre-COVID. Now is the time to invest. And so now this is why we put a whole slew of investment instruments into the market for them to mop it up. But we don't foresee any challenges, as I said, with respect to the exchange rate, etc. If they were, I wouldn't be here sitting back there dealing with them.
I'll go after you.
Thanks for the question, Wayne. We also have high liquidity in Belize, and it's largely concentrated at one of those SIFIs. But like Governor said, it's really reflective of chickens coming home to roost. So you had this out-of-control fiscal policy between 2018 and 2020. And there you saw the pressures on the exchange rate in the country. And so that correction had to have happened. You had pretty much crowding out of the private sector. And now this liquidity has settled in the system, so to speak. And it's largely concentrated, like I said, in one bank. So yes, there were pressures, but it's interesting to see how the timing and the lag effect of these things happen. Maybe, Devon, you could work on this for the next conference. But yes.
Yeah. So just to be clear, we have excess bank liquidity, including excess reserves held at the central bank. So that's one issue, right? In fact, that figure is around 3 billion.
So it's sterilized.
Which is separate from the foreign reserves. So I just want to make sure we're not confusing anybody with foreign reserves and banking reserves or bankers' reserves, right? That's held at the central bank beyond and above the reserve requirement. So the issue for us, and that's a long-standing issue like Barbados and Belize, the issue for us really is the need for us to move from a savings culture to an investing culture in our region. So I give you a particular number. In our region, only 1 in 25 persons, that's 4%, invest in the regional capital and international capital markets. 4%. You contrast that with the United States, it's 60%, 3 in 5. I don't know what the number is in Jamaica, but I know it's a far better number because you have done very well with the Jamaica Stock Exchange and the Junior Stock Exchange. And we are looking at that to see what lessons we can learn. So what we have been doing is supporting vehicles like mutual funds to be able to see our people invest in that. To move from just being savings, we have 25 billion EC, well, that 10 billion US in savings, we want to see some more of that move to investing. And including, as Kevin said, some investment in renewables, for example, some of our renewable energy transition or development to get our people to create opportunities for them. But you have to structure that, and maybe with an IFI, come with a partial risk guarantee or some kind of thing to credit enhance the facility. But we want to see that because the markets are still very, very shallow in our region. So that is a challenge for us to move from this. Even in the pandemic, deposits were growing faster than loans. Even in the pandemic. So even though people were, you had the moratorium of credit, you have the interest accruing and all of that and so on, and facilities work. So even with that, deposits grew faster than loans. So that's the challenge we have structurally that we have to address. And that is part of what we hope to do in terms of bringing that forward.
Thanks, Richard. I want to get back to the topic governing during challenging times. I just want to make a few remarks. I've been in this business a long time. And obviously, all of you would agree with me, is that central banks in the region are one of the strongest institutions that followed good governance. We haven't had any crisis in the region. We have seen in developed countries a number of challenges and crises that they have been involved in, which also obviously exported to the region, but the region was very resilient. So I would like you to acknowledge, and whatever we have heard, is that the central banks in the region, they're one of the best institutions who have upheld the task. Their objectives have been achieved and continue to achieve. I think you could give all of them a round of applause. Not only to them, as you would acknowledge, I also, I mean. And the reason why I'm saying this is that I want you to know that these forums that we have with respect to the governors' meeting, they're not a waste of time. They have grown over time to look at what is more important and what needs to be done. And indeed, as Tim said, and all the governors would have said, this solidarity is beyond whatever you could even think about. We work together, we have time to look at the important issues, and we have acted on them. So we are up for any challenge at any time, and that is the reason why we have gone through so many challenges, coming back to the topic, governing during challenging times, and we have been able to use those challenges as opportunities to make our economy, not just the financial system, very, very resilient, and to provide for the wherewithal of our people. So we have been able to achieve that, and it is because of good governance. Now, this wasn't something just happened. I mean, we had a lot of help. Technology have been very important in our quest to achieve the best for our people. And the central banks have been very, very instrumental in terms of acknowledging that reforms are important and we are willing to adapt ourselves to change. So a number of things have been happening, and our forums that we are having have changed over time. Before, we only used to look at the Center for Monetary Studies, which used to take almost all of our time in our discussion. Now we don't even spend 5 minutes on that. And I want to also, since many of you are attending monetary studies, that you have to be relevant. This was put in place to assist us to ensure that our financial system is indeed the instrument to provide for sustainable growth and development. I have seen a number of papers that were presented. We have talked about AI. We know where and what you are trying to do, but you have to be relevant. And if you're relevant, then you'll be able to provide more to us to make our economy, our region, ones that many would be very, very, I would say, envious of. Those were some of the points I want to make. Thanks.
Thank you, Gorbin. As our senior governor, really appreciate that. But I thought you would have ended by talking to us about the oil that you promised.
We'll have that discussion in Guyana.
Yeah, I mean, any other comments or questions? Yes, John.
Thank you, Governor Biles. I have observations around liquidity and capital. I'm using the Bahamas as an example. The element of liquidity that is less of a concern for us is liquidity that in government securities, because that's just a credit allocation decision for commercial banks. And so it means that potentially over time, as they move out of that, that's how they're going to finance more private credit. But we're careful to boast about liquidity in the other sense, where it's excess reserves at the central bank, because to me that's financial stability overhang. I can reconcile it almost dollar for dollar to money that was printed in the past, central bank credit to government. So for us, a part of the comfort long term is trying to shift some of the credit off the central bank balance sheet back into the private sector to dissolve that element of liquidity. And I think that's a medium and probably more longer than a medium term trend for us. And I think that goes back to the comments about whether some of what we see could potentially undermine, the currency peg over a medium or longer term. And then the other issue, we boast in the Bahamas about the risk-adjusted capital ratios being in the average 30% range. That happened because banking was very profitable for a long period, and banks never repatriated profits the way they would ordinarily do. But it could very well also be fueling the fee issues because that capital has to generate a rate of return. So we also take somewhat of a discounted view sometimes of the reserve numbers because we've started to say to the Canadian banks and others that you need to have a medium-term plan to get rid of some of this capital. Because if it sits there, at some point, they're going to have to try and deploy it in a more risky fashion, or there's going to be the pressure, as we might already be experiencing on the fee side. So for us, the capital also is something I think longer term, we want to see those ratios come down a little bit, but still have, reasonable buffers. Final point or more question is, can governors say, how you're dealing with human resourcing? I hear the low unemployment rate in Jamaica and some of the others. In the Bahamas, I think we're just below 7 and going down. And it seems as if it's now more difficult to retain talent. We're never going to be able to match dollar for dollar the salaries in the private sector. But how are you dealing with the issue of retention and recruitment?
If I could start, I think that what we have found in Jamaica is retention. What's important for retention is, of course, the dollar, the salary. But beyond the salary is work conditions and the work culture. And I emphasize the culture purposely. To the credit of the government in making us independent, they have allowed us to set our own standard of remuneration. And we have a system that is getting us there over a period of time. But concurrent with that, what we are seeking to do is to make the bank a great place to work. And to build a culture of professionalism where people have respect for each other because we're all professionals. It doesn't matter if somebody is a deputy governor or is a new employee. We're all professionals, and so we should show that respect and openness to teach and to learn. That's a big effort that we have made in the last couple of years, and I think I can say that it's having a positive impact in making people feel more comfortable here, wanting to build a career here. And if we can complete on the remuneration side, I think that we'll find that we'll have a staff that is happy, comfortable, and will stay with us. You had a question also, Alvin.
Yes, thanks very much for this very interesting discussion. I want to echo the words of Gobin about the importance of this forum and how it has evolved, and I think the audience should be really proud and to be part of this kind of discussion with the heads of these institutions. I have a question actually for Richard and Jamaica. As the purest inflation targeter in the region, how do you deal with calibrating monetary policy, particularly interest rates, I guess, where inflation is predominantly imported, one, and also with the lags of monetary policy? In other words, you put interest rates up now. It takes a while to get to inflation. Then the U.S. is raising interest rates. Will you follow it point for point? Just those questions, please. Thanks.
Yes, we estimate that 70% of everything we consume here is imported, whether it's a direct consumer product or it is a raw material for value-added manufacturing for consumption. So the effect of commodity prices are very important to us, and it flows right through. And having a floating exchange rate means that that is an important aspect that we have to pay attention to. Also, because we have a free market for foreign currency, we have to be very careful about how our rates, our domestic Jamaican rates, stack up against United States rates. So the tax-free rate here versus the tax-free rate in the US is important. Otherwise, we'll have capital movement. It's a system that has many moving parts. But what it has shown is that over this period of pandemic and the high inflation, that we have managed to come through with stronger growth than we had before, with bigger reserves than we had before, with less debt than we had before. So somehow it works. I don't say that it is better than anything else, but I'd say that it delivers at the end of the day. We have Wayne. Oh, Wayne is gone. Sorry, just when I wanted him. Somebody else here can help me. We have banking deposits today, U.S. banking deposits, which have trended down a bit since the stability in the exchange rate, but is at 40% of our total deposits, which is probably bigger than the reserves we hold, or at least equivalent to the reserves we hold. And people, so it's a kind of system where very market-driven, people get to do what they want to do. They can hold $4 billion of reserves in their private account, whilst the government has $5 billion. We have an exchange rate that is moving. You can buy foreign exchange freely and openly. So somehow we have made it work, made it stable. We have paid a price, a pretty heavy price over the years, especially, I'd say, the last 10 to 12 years with our exchange rate depreciating. But it has finally stabilized more. Expectations are about inflation and about exchange rate is calmer than it was before. So I'm hoping that where we are is in a more mature, totally market-driven, free market, foreign currency, economic environment. We're mindful, though, that it can be destabilized, so we have to be constantly paying attention to it. But that's one of the reasons why I like this forum, because there are we're different in that way, and I look on and I say to my people always, what's happening in Barbados? What's happening in Trinidad? What's happening in the ECCB? To compare how is our system working versus your systems, because at the end of the day, what we want is the best. And similarly, when I go to like SEMLA meetings, I'm always interested in what their experience is, because it's very close to ours. They have floating exchange rates. They are inflation targeting. So it's very similar to what we do here. So all of these international fora, for me, have great and rich lessons for what we are doing. Sorry, Dave? Dave?
That's me. Okay. Thank you, Governor. I mean, this panel has been a breath of fresh air. It's very enlightening. One question I don't think that was addressed is the whole issue of the central bank communication strategy, right? In this new environment where there's so much misinformation about, and there's so much, even when you have information, there's cognitive dissonance, so people don't understand the processes and so on. How has the central bank communication strategy evolved over time, but especially since COVID-19?
I don't know if anyone wants to take it or you want me to answer that.
I mean, I could respond.
Sure, go, no man, you go ahead.
No, so I think if anything, we have increased our channels of communication. So there's the official communication through a weekly podcast, ECCB Connects, but there are other channels that we use as well. We have a children's connection radio program we do once a month, targeting that particular demographic early to build financial literacy, but also build a relationship with their central bank and to hopefully enable them to be responsible citizens. We work with schools through mentorship programs. So we have a range of things we do for engagement. We do country outreach. But to answer your question, I mean, directly, the fake news thing is a phenomenon, it's a reality which we have to constantly monitor. Because, as you said, we have found that there are people who, they're looking for the news that they want to hear or see. They're looking for conspiracy theories, and they will act on those. And so we have to constantly be out there sort of explaining, breaking down what we do. I commend what Jamaica has done. I commend what Barbados is doing. Governor Greenidge I've seen some videos of what he's doing to break it down for ordinary folk. Those are very important steps. But there is a risk that you constantly, going back to the pandemic, is that coming from a reliable source? We kind of stress that. So we do source, when you do research, you talk about your sources, but in this information age, we encourage people, what is your source? Because a lot of times people are taking information and running with it, and the sources are not credible. And we are worried that people will get hurt financially because something goes viral and people run to act. You have to know in this age, consider what it could mean for a bank and a potential run on a bank. I mean, you saw what happened with SVB in the United States, where, what a word, boy, things look shaky, boy, things look shaky. And people started pulling, and then, of course, the mismatch they had with the deposits, and you saw how that played out. Ultimately, the bank failed. So we have taken a lot of steps, but the truth is that we are constantly looking at our communication strategy and what else we can do, because, frankly spoken, we feel we still have to do more. We haven't done enough.
In our case, because we are inflation targeting and we're moving the policy rate dramatically and exchange rate movement is important, we have a fairly sophisticated and rigorous communication channel. Of course, we have a monetary policy committee that has not just BOJ people on it, but has independent persons, no government person on it, neither on our board. So when we meet and we have discussions and make decisions, those minutes are eventually published on our website. Everybody can read everything that we have decided and discussed. But we also have press briefings every quarter, and that's open to all of the media where we make statements, much like what the Fed does. In fact, we fashion ourselves very closely of how the Fed handles their communication. We have a very nice program that we run on television, centrally speaking, which people love because we have two very attractive, very knowledgeable hostesses that everybody seems to think are professionals, but they really work with us. I'm not sure if we're paying them a premium for it. Are any of them here? I hope they're not hearing me. Yes, they're there back at the back. But it's a very successful program, all run by BOJ.
I understand why.
Yeah. Okay, I think we are over time. We want to wrap. Thank you all very much. It was an invigorating session. So we have to break now. Thank you.
Thank you.